Good morning, everyone, and welcome to today's webinar, Understanding the Numbers in Your Trades Business. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You can select audio settings to select and test your speakers. You can submit questions via the Q&A button and we'll answer your questions at the end of the webinar. So please do put them in as we go through and we'll get through as many questions as we can. There is this raise hand button which would allow you guys to speak live during the webinar, but we won't be using that today. And you can click leave meeting if you do need to leave at any time. There will be a short questionnaire at the end of the webinar and we would really appreciate it if you could fill that in for us, because all the feedback we get, we really do take it on board and it helps us improve our webinars going forward. So who are today's presenters? Well, my name is Ikra Aslam and I am one of the client managers here at Roslin Associates, and I'll be taking you through the first half of the webinar. And then Ian, for those of you who don't know him, he is one of the directors at Roslin Associates. He'll take over from me halfway through up to the end of the webinar. Before I start, I thought I'd share a thought of the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. Hopefully, as business owners, you've all updated your budgets and forecasts in the last year. These numbers express your aspirations for the business over the next 12 months. What I mean by that is, if you were to imagine where you see and want your business to be in the next 3 to 5 years, your 12-month forecast and budgets are the first step in getting you there. It is important that you take that time to make sure that you can understand, monitor and measure what you've set in those budgets and forecasts. And this webinar is about demystifying the most common reports you would see on a weekly, monthly, quarterly and annual basis, so that you're in control of your business performance. So over the next 45 minutes or so, we're going to cover the importance of knowing your numbers, an overview of different reports, which you have probably seen before, especially if you or your accountant produces annual and/or management accounts, the difference between profit and cash, the key drivers of business value, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure that you truly understand your numbers. So please do make plenty of notes today. Some of what we talk about might sound like a foreign language to you, but we will make sure that we try and simplify things as best as we can. So do send in any questions you have at any time during the webinar and we'll answer them at the end. Knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve your goals set in your business plan. Before we take a look at the reports, let me ask you some questions. What about your business keeps you awake at night? Just have a think about that for a second. Is it lack of cash? Do you worry about how you're going to pay your team at the end of the month, or your supplier bills, or maybe even HMRC if you've got VAT bills and corporation tax, etc.? Is it the never-ending amount of work you need to get through? Is it confusion as to how you have made a profit according to your accountant, but you've got no cash in the bank account? Is it lack of profits despite the fact that your sales are going up? Does your business seem out of control, perhaps? Small business owners do suffer from these and many other worries that keep them awake at night. So how can we escape all these worries? The first step is to understand and know your numbers in your business. Let me explain why this is important. As a small business owner, you have to make a lot of decisions. For example, it could be around pricing products and services. It could be about recruitment if you need to take on new team members. It could be about purchasing new assets, for example, new vans, or maybe deciding if you need a new premises. To make good decisions, you need to have the right information, knowledge, and skills. Without the right information, knowledge, and skills, decisions are made from guesswork and emotions. Every decision on business has an effect on the short, medium, and long-term numbers, whether that's cash and/or profit. Making decisions without knowing the numbers and how they work in your business is like driving without knowing what the road signs mean or what the various lights and indicators on your dashboard mean. Eventually, you're going to either get lost or have a breakdown. So based on that, here are the 6 reasons why you need to understand your numbers. First of all, they tell the story of your business. So you can take a look at your figures from when you first started your business to now and analyse any trends. It could be that your sales have grown year on year. It could be that your gross profit has declined over the same period. It helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, rework, poor purchasing, or even wastage. This is really important because, like everything in life, you need to get to the root causes to solve the problem and not just treat the symptoms. Knowing your numbers will enable you to spot an early warning sign of any potential issues. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. So let's say if on average your customers usually take 30 days to pay, if that number starts to increase over a few weeks or months, you can nip it in the bud and put processes in place. Otherwise, it will have an impact on your cash flow. Areas of strength and weaknesses will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. So we're going to have a look at each of these key reports to help you understand why they are important and what you can learn from them. We'll look through an example to show key learnings and things to look out for in your reports. And we're just going to use a made-up company throughout the reports. So first of all, I'm going to have a look at the trading account. And your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. This is a very important measure. It's often tempting to just focus on sales. However, it's the gross profit which is more important. For example, a £1 million turnover company, that's sales, with a gross profit of 50% is less profitable than a company doing 800,000 in sales with a gross profit percentage of 70%. If it suits your business, you can track your results across different types of work using multiple trading accounts. For example, if you're an electrician, you might want to split work into residential and commercial. Having a trading account for each type of work allows you to track how each one is performing. The benefits of splitting it is to check the gross profit for each type of work, because if you had them together, one might be making a loss and you wouldn't even know about it. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'm going to show you now. So this is an example of a fake company's trading account. As you can see, they had sales of just over 1 million. Cost of sales of 318,000, giving them a gross surplus from trading of just under 700,000. Their direct costs were just over 450,000, so their gross surplus was 248,749, giving them a gross profit percentage of 24%. Now let's say this company undertakes some coaching with their accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. They renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by 140,251, and their gross profit percentage has increased from 24% to 35%. So understanding your trading account allows you to identify areas where small improvements can have a big impact on profitability of your business. It is important to stress here that every business's trading account is going to look different. It is all dependent on your business in terms of how your trading account should look. If you're unsure about your own trading account, just get in touch and we will be able to help you out. So moving on to the profit and loss statement, it shows all your earnings and costs over the year and tracks the overall performance of your business in terms of the profit or loss made for the year. It matches your income and expenses for the period, with adjustments made for timing differences. For example, sales that have been made but cash hasn't been received yet. That's one of the reasons why the profit and loss statement doesn't reflect your bank balance. That's why it's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement also includes non-cash expenses such as depreciation. You must also ensure you have sufficient profit to cover cash costs such as the capital elements of your loan repayments or asset purchases like vans and drawings, because these items don't show on your profit and loss. But Ian is going to talk more on profit versus cash later. It can be useful to think of the profit and loss statement as starting with the gross profit, which we looked at in the previous slide, at the top, and then taking off the overheads such as rent, admin salaries, IT support, utilities, etc. These are the items that don't usually vary significantly with the level of sales, but of course over time they will if your business is growing. For example, you might need more office staff or a bigger office. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver of the value of your business. So basically, the higher your earnings, the higher your value. So this is an example of a profit and loss statement using the same made-up company. And we've taken the gross profit from the trading account and listed all the expenses followed by the owner's salary to calculate the net profit or loss. And as you can see, the company is currently trading at a loss of over 113,000. So when you see a figure with brackets, it does mean loss. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurances and rent. They contact an insurance broker and their landlord and negotiate a 5% reduction of both expenses. They've saved £597 in insurance expenses and just under £3,000 in rent expenses. However, you'll notice that the accountancy fees have gone up, and that's because if you remember from the last slide when we were looking at the trading account, they spent extra time with their accountant on coaching and other services. But despite the fact that the accountancy fees have increased, the overall net surplus has increased by 138,000 to 24,000 due to the savings. So that's taken them out of a loss and into a profit. Some of you might be able to see that this enables us to break out the break-even point of a business. Basically, this is when the gross profit equals the expenses and overheads. In this case, before any changes, the gross profit needed is 248,749, that's this figure up here, plus the loss of 113,858, and that equals 362,607. We can then gross up using the gross profit percentage to calculate the sales needed to break even. In this example, the starting gross profit was 24%, so the sales needed to break even are just over 1.5 million, when they actually did just over 1 million. For a new business in particular, this vital number is needed to be known. Hopefully you can see how understanding this can make a huge difference to the performance of your business. I'm now going to pass over to Ian, who's going to talk you through the balance sheet and the rest of the webinar. Remember, do pop in any questions you've got in the Q&A button and we'll answer as many as we can at the end. Over to you, Ian.
Thanks, Ikra. What I'm going to do now is try and share my screen, and there we go. Great. So Ikra's set out the profit and loss, and that, sorry, I'll just put my, if I can just sort this out. Bear with me just 1 second. Can't seem to get it to work. Anyway, hopefully you can see the screen there. We talked about the profit and loss account, and that is what a measure of the business's financial performance between two specific dates. And what I find is most people find that reasonably easy to understand, what your sales were, what your cost of sales, and what your overheads were. Once you start talking about balance sheets, an awful lot of people start to sort of glaze over, to be honest, because it's like, what is it? How does it work? In essence, it's actually fairly simple. A balance sheet is a snapshot of the health of the business on a particular date. So the profit and loss is what happens between one balance sheet date and the next. So what does that snapshot look at? What it looks at, it lists out all the assets of the business, assets such as buildings, vehicles, stock, cash, money owed to the business, that sort of thing. It lists them all out and adds them all up, basically. And then you look at all the liabilities of the business at that date. So there could be VAT bills, supplier bills, loans, these sort of things. And you add all these up, you take one from the other, and that gives you your net assets of the business. All the stuff that is worth something against all the stuff that they're going to cost you something. Hopefully that's helpful. And it says it measures the net worth of the business at a point in time. That's a slight proviso on that is that the figures in the balance sheet aren't necessarily the market value of the assets. So they're what's called the book value. In other words, usually what it cost you. Now, it says it shows if your business is solvent. Now, what that means is if the assets are more than the liabilities, then you should be able to pay all your liabilities at some point in time in the future, so the business is solvent. I'll go into explain a little bit more about that in a minute. You can look at comparisons between periods. So for instance, what were your net assets at the start of the year? What were they at the end? Have you improved it? Is the business getting better or worse? And as you say, you can track the strength of the business over time. You can see, the assets are building up, etc. And it's a basis for calculating key ratios. Again, something else I'm going to talk about in a minute or two. So what I'll do is go on to the next slide, which is an example of a balance sheet for a trading company. Now, some people look at that and go, I don't understand that. It's actually, as I said, at the top, you'll see, if I get the mouse over there. Yeah, you can see there's the assets, and they're all added up to 548,000. And this half has got all the liabilities, and they're all added up to 853,000. So the company has a negative balance sheet, negative assets, its liabilities are £305,000 more than its assets. But perhaps more usefully, if you look at the current assets, now current assets are things like money in the bank, stock, things that people owe, money that's owed to you by your customers, that sort of thing. These are things, think of them as things that can be converted into cash relatively quickly. So that for this company, they're 138,000. Then going down, there's current liabilities. Now, current liabilities are things that are going to take up cash, use up cash in the near future, such as paying your credit card bills. Your current account, well, it might not seem like it's a current liability, but technically the bank can demand it being repaid at any point. Tax payable and supplier bills, obviously. So these are all things, the current liabilities are things that that's going to take cash out of your business. So the current assets are things that are going to create cash or are cash, and liabilities are things that are going to use up cash or are an overdraft. Now you can see in this example, the current assets are 138,000, but the current liability is 162,000. Now that is a real problem for the business, because what that means is that it's possible that they'll run out of cash fairly soon, because there's quite a difference between the two. So this business has to by looking at the balance sheet on a regular basis, you can see if this comes up in front of you right away, there's a potential cash issue here. What can we do about it? And things that you can do is, we'll get some cash in, but that's not going to increase the actual total. It's just going to shift it from receivables from your customers into cash. The only way to really do it is either to get funding from outside the business, not loans, because you can get long-term loans, which will then increase your current assets and you'll get more cash, and it'll move the liability into long-term. But I don't want to get too complicated about this. Essentially, you need to trade and make profit and keep the profit in the business. If you do that, the chances are that your cash will build up and your liabilities will go down, and you'll be back into a solid position. So the business has a major problem there in that its overall assets are negative, as I said earlier, at 305,000, and it might take a bit of trading to get out of that position. You might have to renegotiate loans. You might have to, in some instances, and it's maybe a bigger company, you might have to issue shares to investors in order to get some cash in and reduce the outstanding debts in the company. So just moving on, what I was going to talk about next is ways to get some cash in. Now, debtor days. What are debtor days? It's a bit of jargon, accountants speak. Debtor days are fairly simple. If you look at your profit and loss account that Ika was talking about and divide it by 365, that tells you roughly, on average, what your daily sales figure is. And if you look at your trades and other receivables there, 72,000, that's highlighted, basically divide that by that daily amount, and that tells you how many days sales you've invoiced but haven't been paid for. So how many days of work on average you've actually got outstanding, and this is something which you can measure. Why would you want to measure it? You want to measure it because if you improve that by 5, i.e. reduce the number of days sales that have been invoiced but not paid, then you will get cash into the business. And in this case, a 5-day improvement would give you almost £14,000 of cash. So you can see measuring debtor days is a really important one, because it helps with your cash flow. If you're measuring it on a monthly basis and it starts to go up, you need to ask yourself, are my debt collection systems working properly? Why are people taking longer to pay us? So that's something to watch. Similarly, stock days. Now that is very similar, because what it is you look at your cost of sales. Now that's the direct cost. If you remember, for a trades business, it's essentially your stock, your materials. So you look at that and see what the figure is, and then work out from your cost of sales divided by 365, you can see what your daily use of stock is, and then you can work out how many days stock you've actually got on hand. Now, I've seen businesses that have got like 3 months stock in hand, but they don't need that much. So that money that's cash tied up in stock that they could be using for other things, paying their bills, etc. In this case, this example, if we improve it by 9 days, the company would have another £7,860 in the bank. So these are things that you can track when you've got a proper balance sheet. You can say every month, right, okay, it's gone down now. That's great. We're obviously doing something right, or it's going up. We need to do something. So after that quick run through of a balance sheet, what I want to talk quickly about is the difference between profits and cash. Now, anybody who came to our last webinar will know that we talked about that in quite a bit of detail last time. And as it says there, turnover is vanity, profit is sanity, and cash flow is reality. Now, turnover is vanity, and Ika touched on this earlier, because if your gross profit rate and your overheads are too high, you might not make any money at all. You could be £1 million company and making no money. I've seen it. Profit is sanity in the sense that your accounting profit is great, but if you don't actually get your customers to pay you, then you're not going to last. And businesses, they can be profitable and run out of cash. So that's why cash flow is reality. Cash flow, especially a startup business, but it can happen at any point in the business. Cash flow is crucial, absolutely crucial. It's like your lifeblood. In other words, if it runs out, you're dead. Okay. So just to explain this a bit further, you can see the titles are profit and cash. What I'm going to do is just look at 3 or 4 or 5 items that go into your accounts and wonder whether they affect your profit or your cash. I'll do it slowly so you can think for yourself what first. Does VAT influence your cash or your profit or both? It affects your cash only. It doesn't affect your profit, because your profit is calculated on your net of VAT sales less your net of VAT expenses and overheads. So it does. So the VAT payment, it certainly affects your cash. If you're paying £20,000 to £30,000 a quarter in VAT, you can see it, does your bank account just disappearing, but it doesn't affect your profit. What about loan repayments? What I'm thinking about here is the capital element of the loan repayment. Does it affect cash? Well, it certainly does, because cash goes out the bank to pay the loan off, but it doesn't affect your profit. Loan repayments have to be made after your profit has been calculated. Interest on loans, what about that one? It affects both, because the interest is an expense of the business and it gets deducted in your profit and loss account. It also is cash, because you have to pay cash. You have to use the bank to pay the loan and pay the interest on the loan. What asset purchases? You decide you're going to buy a new van and you've got plenty of cash in the business. So does it affect your profit or your VAT or your cash? It actually only affects your cash. The purchase of an asset doesn't affect your profit and loss account. That might surprise some people. Asset sales, exactly the same. You sell the van, you get some cash for it. You certainly affects your cash. You get money coming into the bank account, but it doesn't affect your profit and loss at all. Finally, depreciation. This is the odd one out, because depreciation affects your profit. And for anybody who doesn't understand, depreciation is what you put through in your profit and loss account each year to reduce the value of any assets that, like vans. So you might buy a van for, let's keep it simple, £10,000. You might depreciate 20% a year. So you take £2,000 off the value of the van through your profit and loss account. But it doesn't affect your cash. It's purely an accounting entry. So hopefully that explains some of the differences. Why? Because if all these things on the other side, loan repayments, asset purchases, if they're significant in a year, that could use up all your profit. So when your accountant tells you you've made 50,000 profit, but if you've bought a van for 30,000 and you made £20,000 of loan repayments, you'll have no cash left. So I'll move on to what's called the business 101 cycle. And this is a useful way to helps demonstrate the difference between profit and cash. And it also helps a nice little model of how running a business generates value. So go back to if you're in business, go back to when you first started. You left your job, you started your own, maybe a company, maybe self-employed, but you needed some assets. You needed a van, you needed tools, some materials. So how did you do that? You put some money, your own money probably, into the business, and you bought some assets, as I say, vans, tools, etc. Great. You might find that you didn't have enough money and needed more stuff, so you might need to borrow some money from a loan. You might get an overdraft, or you might borrow some money from somewhere else. Whatever it is, you use that money to buy the assets. These assets that appear in the balance sheet, remember, you use those assets to generate income, sales. So, assuming you've got your pricing right, you will make a profit. You'll use those assets to generate income and a profit from that. That's called a return on assets. Now, ways to make that profit bigger are getting more sales, so sales growth, or getting your gross profit margin, as Ikra showed earlier. In that example, it went from 24% to 35%, generated more profit. Things that might stop you generating more profit, particularly here, are obviously the opposite of the gains, but as well as that is the unchecked overhead expenses. And what that means is, I've seen it again, people get excited, they've got their first payment from their customer, so they go out and buy something to reward themselves. It could just even be just getting the deluxe van or something like that, or something that you don't really need, so that can actually drain your profit. Although I did say before that buying an asset doesn't affect your profit, so maybe that wasn't a good example. It might be better saying you decide you're going to get a shop front, but you don't really need it, but you think, oh, I've got money, I'll do that. Okay, so you've done your profit, but you haven't been paid yet. The customers have got their invoices, but you have made a profit even though you haven't got the cash yet. Then cash comes in when people start to pay you. Now, what stops that? What stops the cash coming in, or make slow collection of debtors? It says there. That's basically not getting the money in from the invoice. And I've seen this so many times. Assuming they've even got round to invoicing, an awful lot of trades companies, small ones particularly, will send the invoice out and then just hope. Just hope that eventually they'll get paid. And obviously that's reflected in the debtor days we've talked about before, because in a sense, when you've issued your first invoice, if you think about it, going around the profit cycle, issue your first invoice, you haven't been paid. So 100% of your sales have not been paid yet. So depending on how long that period is, that could be 365 days if it took a year. So basically, reducing the number of days will help that cash come in quicker. Increase in stock or work in progress. Now, stock is materials, basically. We all know what that is. Work in progress is work that you've done that you haven't invoiced yet. So, for example, you could be doing a 3-month contract on a commercial building or something. You really don't want to wait till the end of 3 months, obviously, to raise an invoice. So the quicker you can agree with your contractor or your customer to actually get paid, to issue invoices, the lower your work in progress will be, because you'll have converted it into an invoice and you'll get paid sooner. Business loan repayments, again, if you've borrowed money from the first step, well, the second step of the assets section, you might have to pay it back. Now, that's why, for instance, with the some of the loans, the bounce back loans, etc., last year or this year, they're becoming payable. But last year it was great because you didn't have to pay anything out. But now they're going to come in, that will drain the cash from your business. And business tax payments, obviously, you've got to pay, like we said before, VAT affects your cash, corporation tax affects your cash. And the last one there, faster payment of suppliers. And I have seen this now and again as well, people who feel that as soon as they get the invoice from the supplier, they need to pay it because that's what they were told to do when they were growing up. Always pay your bills on time, or pay them as quickly as you can. That will affect your cash because your cash is going out sooner. So how can you, what sort of things can you do to make it better? Faster collection, get a really good solid procedure in place for chasing up invoices and making sure they get paid. There's all sorts of things you can do there. And the worst thing you can do is nothing. Decreases in stock or work in progress. In other words, if you use up stock but don't buy any more, obviously that stops you paying out cash, so you've got more cash in the business. And slower payment of suppliers. Negotiate good terms. if you haven't negotiated with your suppliers in the last year or so, often what happens is when you start up, you have to pay cash. Obviously, they don't know who you are. They're not going to hand you, £3,000 worth of materials and then you'll disappear. Well, that's what they think. So, but if you've been buying it, and then maybe you can get a small sort of credit, maybe 30 days or something like that. And if you've been doing that and you've been paying on time, and you can always go back and ask again, could we make it 60 days? And that really helps your cash flow. And obviously reduce tax payable, and that's one of our specialities, is helping successful businesses pay as little tax as they have to. And then at last in this cycle, the owners get to take some money out for themselves, assuming they've generated profit from using the assets and they've converted it into cash by customers paying them. Taking some cash out will obviously reduce the amount of cash in the business, but you have some control over that. And it's, as it says, as personal loan repayments, but at last you're getting some reward. So if you accelerate that cycle, essentially you can generate cash more quickly and increase the value of the business. Now, if you draw every penny out of the company or the business won't necessarily increase in value. But if you leave some cash in the business so that it can be used to buy other assets, maybe recruit people, etc., that increases the value of the business. Okay. So we've looked at the balance sheet, assets, less liabilities. We've looked a little bit at debtor days and how you can manage your cash. We've looked at the business 101 cycle, which explains how that whole thing works and what things you can do to improve it and speed it up. What we're looking at here is how you don't want just to understand the numbers, you want to be able to improve them. There's no point in just understanding them. It sounds a bit like Karl Marx. The point, people have understood the world, the point is to change it. You understand the numbers, then you do something about it to improve them. And what I've got here is an example of 6, some people call them KPIs. There's 6 measures that you could keep a track of and track on a monthly basis, which in my experience are the most likely to be the important ones for a trades business. The first one, sales. Obviously, you need to track your sales. I mean, how much are you invoicing on a weekly, monthly, quarterly, annual basis? And as Ikra said, the gross profit percentage is absolutely crucial. If you get that wrong, I've seen people think they're doing really well until they actually work out what their gross profit percentage is, and that can knock out your profit straight away. Next 3 are mainly to do with cash. Debtor, I talked about them already. Debtor days, how many days work have you invoiced that hasn't been paid yet? Creditor days, how much of your daily stock use have you not paid for yet? You want that to be as high as possible, obviously by negotiating better terms. And stock days, again, similarly, we talked about that. How many days stock have you actually got sitting in the warehouse or in the office or wherever? And finally, net profit. Basically, at the end of the day, you've got to make a profit. But if you monitor, if you set targets for all of these, sit down and say, right, if we get all these right, we will make the profit that we want for the year. And that can be whatever you want it to be. Then you can measure whether you're on track on a monthly, weekly, quarterly basis. So in order to enhance the business value, to get it a more valuable business, one of the first things you've got to do is have a clear plan. Where is the business now? Where do you want it to be in a year, possibly 5 years, possibly 10 years? What's your ultimate exit plan? And what are the stages to that? Effectively, you want to be turning over an X amount and making X net profit at the end in 5 years' time. What are the steps to take to get there? If you're big enough as a business, you would want to document your organizational structure and the roles. What I find is that when a business gets to maybe, I don't know, 5, 10 employees, they're a certain size, and things start to get a little bit vague as to who's supposed to be doing what. And often it's the directors themselves that don't know what they're supposed to be doing. So by creating an organizational chart and clarifying the different roles within the business, it could be engineer, apprentice, finance manager, whatever. get the roles in place, then you can build on that. You can recruit to fill the boxes, the particular roles, and it makes a huge difference in clarity of what everybody's doing, and everybody being aligned in the same way. I'd say you need to establish cloud-based real-time reporting. And by that, I mean financial reporting. So that's using something like, well, so I know a lot of people use Simpro in the trades, but the accounting software would be Xero, we'd always recommend. That way, as long as the bookkeeping is done regularly, is kept up to date, and is done properly, then you can be anywhere in the world, log into it and find out exactly how the business is doing. So if you want to take 3 months off and travel the world, as long as you've got an internet connection, you can still keep tabs on how everything's going. Review and document systems and processes. Yep. Again, that's similar to the document organizational structure, but it's all the processes in your business, your standing operating procedures, and I've heard it called the Bible, how we do things here. Get that written down, because when you start a business, you often start off, and it's all in your head. As things develop, it's in your head. You're the owner. It's in your head, but you can't sell what's in your head, or you can't get other people to do what's in your head. So you need to get it out there in the systems, and so that everybody can follow. This will then reduce the reliance on the owners. So if you're running your business and you're, as Ika was saying, all the different things that keep you awake at night, how am I going to pay my bills? I can't get time off to go on holiday with my family. By doing all these other things, you reduce the reliance on yourself, so you can actually get time off. And finally, it helps you to identify and manage risks. In other words, you look at looking ahead a bit to see what's going to happen. By doing a business plan and knowing where you want to be, you can look ahead and see what things might be coming. So how do you do this? It's all very well understanding it and knowing what to do, but do you know how to do it? And we believe there's 3 essential tools every business needs, and that is, firstly, an annual business plan. So that's essentially, as I said before, it's looking ahead a year, 5 years, and coming back so that you know why the business is there, who your ideal customers are, what you're trying to achieve, what's important to the business, its values. So there's complete alignment between the business owners, if there's more than one, and also between the owners and the team. So everybody knows what they're trying to do. Then you need an annual forecast, and that is essentially basically saying, this is what we're going to do financially over the next year. Now you can sit down and work out. There's a method we call bottom-up budgeting, which can take into account loan repayments, asset purchases, etc., to see what profit you need before tax in order to achieve your goals. And you can work backwards again up to know what your sales need to be, and then you use that. You can then input that into software that we have, which then you can produce reports which says, this is what your budget, your forecast says, and this is what you actually did. This is what Xero is telling us you did. And there's where the variance is. And again, this is the ongoing reporting you can look at and see, you said you're going to do 25,000 turnover this month, you've done 18.5, what's happening there? And this is where the accountability comes in. You need someone out with your business to be able to sit down with you and be honest. They're not invested in the sense that they're not emotionally connected with the business. They're not emotionally connected with the owner. There's no benefit to them either way, as long as they're getting paid if that's appropriate. So the accountability is the sort of final part of it. And as it says there, knowing your numbers is just the beginning, but doing something about it really is the important part. So your next steps, as they say, there's no time like the present. Why put it off? Get started now. And what I'd encourage you to do is write down 3 actions or projects that will add value to your business. So in other words, a problem is an opportunity to create a project. Now, what that means is you're sitting there thinking, my biggest problem at the moment is cash flow. Right, okay, well, we've given you some insight in how you could start tackling that, how you could improve your cash flow. Create a project, say, go to your last set of accounts and say, right, what are our debtor days? What are our creditor days? How much stock do we have on? Is there a way we can, and what's our gross margin? All the things we talked about earlier. What are they now? Where do we think they could be, and what impact would that have on our profit and cash? So go and do that. If that's what it is for you, it might be something else. It might be just profitability. You might have plenty of cash, but not making any money at the moment. Lots of different things. Do something. I hope you've written it down. Quick insight into how we can help. I talked about business planning, doing a business plan. We can do that. Annual financial forecast, the one that using the bottom-up budgeting to say this is what we're going to do over the next year. If you want to meet quarterly to go over these results, that's possible. Some people prefer monthly because it keeps, the more often you do it, the more likely you're going to stay on track. Quarterly is fine if your business, if you've got a good handle on your business. Monthly could be better for you, depending. Management reporting, it says that it's free to existing clients using Xero. That is true. It's something we're rolling out gradually, because one of the things we find is that sometimes, well, it's like the old thing about computers, garbage in, garbage out. If we're not doing the bookkeeping, then we have to be happy that the bookkeeping is at least up to a standard. Otherwise, the reports that come out will just be rubbish. And finally, a complimentary meeting. That's up to an hour to discuss some of these things that we've talked about today. Look at things like, what were you trying to achieve when you started your business? What do you want to achieve now? What things are getting in the way? What do you need? What sort of things would you need to do to improve it? And it can cover anything at all. And you can even be talking about tax if that's something that's a big thing. There's a complimentary meeting for up to an hour. And if you're interested in that, just let us know. So hopefully that's given you some basics. We tried to keep it as simple as we could, so that for people who haven't really any idea how the finance works, hopefully now you understand profit and loss, you understand the balance sheet to some extent, you understand things you can do to improve your cash, and you understand the business 101 cycle. So how putting money in, buying assets, generating work, invoicing it, and getting paid, how it's a cycle that goes round and round. So I'm going to ask Ikra, are you still there? Have you got any questions? Do you have any questions?
Yes, we do. We have got a couple of questions so far. So if anyone's got any other questions, please do put them in the question and answer box, and we'll get through as many as we can. So we've got a couple so far, Ian. First one is, what is the difference between annual accounts and accounts that can be produced throughout the year?
Well, in some ways there's not much difference, but annual accounts are based on, especially a limited company, they're based on standard accounting practice. In other words, there's some legal and sort of standard ways of doing things, and the annual accounts have to reflect that. Annual accounts are also after the fact. You can't do your annual accounts until after your year end. So if you've got a May year end, you can't do your May 21 accounts because we're not at the end of May yet. So they're always historical, whereas doing accounts throughout the year, you can make them whatever you want. And these are essentially management accounts. And it depends on what the goals and the measurements that are important for that business, how you actually structure these. And this is when I was talking about real time. Essentially, as long as the bookkeeping is done at least on an end by each month, and then once it's completely up to date, you can generate reports which tell you important information about the business. So really, that's it. One's a historical, almost statutory legal requirement. The other one is a tool to help you understand how your business is going right away, if that makes sense.
Yep, thank you. The next question we've got is, what is the difference between markup and margin? You've spoken about gross margin. Is that the same as markup I put on my prices?
Excuse me. No, the markup and margin are not the same thing, and it's absolutely vital that you understand the difference. Markup is how much you add to your costs when you invoice. So if let's keep it simple again. If you buy materials for a job that are £200 and you do £100 markup, you sell it for 300, and your markup is 50% because it's half your costs. Yeah. Whereas your gross profit percentage, or your margin, is 100 divided by the sale price, which is 300, so it's 33%. So if you get the two mixed up, so if you say, right, we're going to go for 50% gross profit, and then you buy stuff for £200, mark it up by £100, but you only make £100 profit, you're not making a 50% gross profit, you're making a 33% gross profit. Yeah, so that can make a huge difference on your profitability at the end of the year, massive. So I hope that makes a difference. That's clear.
Yeah, thank you. That's all the questions that we have so far.
Okay, so if there's no more questions, I just want to say thanks to everybody for coming along today. Appreciate your time's valuable. There should be a brief exit survey once you leave the meeting. So if you could fill it in, it really helps us improve, what sort of webinars that our people would be interested in. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. Thank you very much.
Thanks, everyone.